I made my first million at 30, my first billion at 50. Know what changed? I stopped doing stupid things. People chase the secret to getting rich, the magic stock, the perfect timing, the insider tip. There is no secret. There's just a list of stupid mistakes. Avoid them and you win. I've spent 70 years watching smart people destroy themselves. The same mistakes over and over. And you're making some of them right now. 7 mistakes that will cost you decades, not months, not years, decades of your life. Most people don't figure this out until they're 60, broke and blaming everyone else. I'm giving you the list today. If you're making even 3 of these, you're already 10 years behind. This is the Warren method. No hype, no predictions, just what works when everything else fails. Mistake number 1. You learn from your own mistakes instead of others. Wrong approach. I'm not smart enough to make every mistake myself. I don't have the time. Neither do you. So I read obsessively, not self-help books, not success stories, but failure stories. I studied every major market crash, every corporate fraud, every bankruptcy. Why? Because the same patterns repeat. The same stupid decisions. The same warning signs everyone ignores. You think you're different? That when the next bubble comes, you'll be the one who sells at the top. You won't. Unless you study what happened to the fools who didn't. South Sea Bubble, 1720-300 years ago, and people still fall for the same scam. Tulip Mania, Railway Mania, dot-com bubble, housing bubble, crypto bubble, same pattern. Mass delusion. This time is different. It never is. I studied the Great Depression before I was even born. I learned what not to do. I read about people who lost everything because they borrowed money to buy stocks. Margin calls wiped them out. What did I learn? Never use leverage. If you can't afford to own it outright, you can't afford it. I read biographies not to be inspired, but to catalog mistakes. Andrew Carnegie made mistakes. J.P. Morgan made mistakes. Even Benjamin Franklin lost money in ridiculous schemes. They wrote it all down. I just had to pay attention. What do? You lose money in crypto and act surprised as if you're the first person to fall for a get-rich-quick scheme. You buy a stock at the top, it crashes and you're shocked. But it happened in 2000, 2008, 1987, 1929. The information was there. Thousands of books. Documentaries, case studies. You just didn't read them because you were too busy watching top 10 stocks to buy now. Learning from others' mistakes isn't just cheaper, it's faster. I compressed 300 years of market history into a few years of reading. I didn't have to live through every crash. I didn't have to lose money in every bubble. I just had to read about the people who did. What to do? Read one investing disaster case study per month. Just one. Pets.com webvan. Companies that raised billions and went to zero. 2008 financial crisis. Lehman Brothers, Bear Stearns. How did they collapse? What were the warning signs? Long-term capital management. A hedge fund run by Nobel Prize winners. Geniuses. Their model said their strategy would only lose money once every 1,000 years. They lost everything in 4. Oh, what? Enron? Not just that they committed fraud. How did they do it? What accounting tricks did they use? Why did smart auditors miss it? Each story saves you from making that mistake yourself. Boring? Yes. Losing money is more boring. Mistake number 2. You buy things you don't understand. This drives me crazy. My rule is simple. If I don't understand it, I don't buy it. Sounds obvious, right? Then explain to me why you bought crypto in 2021. Can you explain how blockchain works? Can you explain mining? Can you explain proof of work versus proof of stake? Can you explain why Bitcoin has value? No. Then you weren't investing. You were gambling. And now you're mad because you lost. What kills people? They spend an hour researching a $50 toaster on Amazon, reading reviews, comparing features, checking if it has a bagel setting. But they'll throw $10,000 into a stock because some guy on Reddit said, "Diamond hands to the moon," and posted a rocket emoji. I passed on thousands of investments, huge winners, companies that went up 50x, 100x, and slept fine. What? Because I didn't understand them. I'd rather miss a winner than lose money on something I don't get. Tech stocks in the 90s, didn't understand them. Everyone said I was an idiot. You don't get the internet, old man. Maybe. But I also didn't lose money when they all crashed. Amazon early on didn't make sense to me. Jeff Bezos was losing money every quarter and people called him a genius. I didn't get it. Did I miss out? Sure. Amazon went up 100,000%. Did I lose money? No. That's the point. The test. Can you explain your investment to a 10-year-old? I own part of a company that sells soda. People like soda. They buy it every day. The company makes money. They give me some of it. Coca-Cola. Simple. Understandable. Around since 1886. Still selling sugar water. Still making money. I own a synthetic collateralized debt obligation that leverages proof-of-stake consensus mechanisms to yield farm governance tokens in a decentralized autonomous organization. What the hell does that even mean? If you need 15 minutes and a whiteboard to explain it, you don't understand it. You're just repeating words you heard on YouTube. Another test. Can you explain how it makes money? Not why the price will go up. That's speculation. That's hoping some bigger fool buys it from you later at a higher price. How does the business generate cash? Where does the profit come from? If you can't answer that in one sentence, you're gambling. What to do? Go through every investment you own right now. Every stock, every fund, every crypto token. Ask yourself, how does this make money? If you can't give a simple, clear answer, sell it today. You're about to learn an expensive lesson and I'm trying to save you from it. Mistake number 3. You're in a hurry, you want to get rich by Thursday. Look, I built my wealth over 70 years. Not 7 months. Not 7 years. 70 years. And people ask me all the time, what's the secret to getting rich quick? There isn't one. That's the whole secret. There's no shortcut. No hack. No loophole. Just time and compound interest. The big money isn't in buying. It's not in selling. It's not in timing the market or finding the next Amazon. It's in the sitting, the waiting, the doing nothing. But you can't sit still, can you? You can't do nothing. Kills you. You see someone make 200% on a meme stock in 3 weeks and you panic. I'm missing out. Everyone's getting rich but me. I need to do something. So you start trading, day trading, swing trading, options, crypto, chasing every hot tip on Twitter, Reddit, and TikTok. 5 years later, you've gone nowhere. Actually, worse than nowhere because you paid fees and taxes on every stupid trade. Meanwhile, the boring guy who bought an index fund 5 years ago and forgot about it? He's up 60%, 70%, 80%. He doubled his money. He's sleeping well, not checking his phone every 5 minutes, not having a panic attack every time the market drops 2%. Not arguing with strangers on the internet about why his stock is going to the moon. The math you don't want to hear. 20% per year doesn't sound exciting. It sounds boring. It sounds slow. But 20% per year for 60 years turns $10,000 into $500 million. That's not a typo. That's compound interest. That's what Einstein called the eighth wonder of the world. Not because it's flashy, but because it works. But you don't want to wait 60 years. You want to be a millionaire by 30. So you take risks, big risks, stupid risks. You use leverage. You trade options. You go all in on speculative garbage. And you know what happens? You lose it all. Or you make some money, get cocky, and lose it all on the next trade. You don't need home runs. You don't need to find the next Tesla or Bitcoin. You need to avoid strikeouts. Hit singles. Get on base. Don't swing at bad pitches. That's it. That's the whole game. But your ego won't let you play it that way. You want to brag at parties? I made 500% this year. You want to screenshot your portfolio gains and post them on social media. You don't want to say, I'm slowly compounding wealth over decades by investing in boring companies and index funds. That's not cool. That's not impressive. Nobody's going to give you likes for that. But it works. And your way doesn't. Reality check. If you've been investing for 5 years and you're not beating a simple S&P 500 index fund, you're not an investor. You're a gambler with a losing record. The S&P averages about 10% per year over the long term, just sitting there doing nothing. No genius required. No special knowledge. No hot tips. If you're doing worse than that after all your research, all your trading, all your stress, all your subscriptions to trading newsletters and premium Discord groups and stock picking services, you're literally better off doing nothing. Just buy the index fund, set it and forget it, go live your life, play with your kids, learn a hobby, check back in 30 years, you'll be rich. Not exciting but correct. The brutal truth. 90% of active traders underperform a simple index fund over 10 years. 90%. Those aren't good odds. You're not special. You're not the exception. You're part of the 90% losing to a robot that costs $3 a year in fees. Mistake number 4. You think diversification means owning everything. Wall Street loves telling you to diversify. Don't put all your eggs in one basket. Sounds smart, right? So you do what they say. You buy 50 stocks. You buy international funds. You buy bonds, REITs, commodities, crypto, gold, silver. You own everything. Congratulations. You've achieved perfect diversification, and you own nothing. Here's what I actually said about this. Diversification is protection against ignorance. It makes very little sense for those who know what they're doing. If you truly understand investing, you don't need 50 positions. You need 6, maybe 10 if you're feeling cautious. At one point, 90% of my net worth was in one company, Berkshire Hathaway. Was I crazy? Reckless? No. I understood that business inside and out. I knew how it made money. I knew the people running it. I knew Warren for 50 years. I wasn't diversified. I was concentrated in what I knew, and it worked out pretty well. Now, I'm not telling you to put 90% of your money in one stock. Unless you're me or Warren Buffett, you probably shouldn't. But here's the problem with over-diversification that nobody tells you. When you own 50 stocks, you basically own the entire market, which means you get market returns, about 10% per year. Fine. But you also can't possibly understand 50 businesses. Nobody can. You don't have time to read 50 annual reports, follow 50 management teams, understand 50 different industries. So you're not really investing. You're just building a do-it-yourself index fund, with more work, higher fees, more taxes, and probably worse returns because you'll make mistakes picking those 50 stocks. You'd literally be better off just buying an actual index fund and saving yourself the headache. The smarter approach. Own 8 to 12 businesses you understand deeply. Not 50 names you picked from a stock screener because they had good P/E ratios. Not everything because you're scared and don't know what else to do. A concentrated portfolio of businesses you've actually researched, companies you understand, industries you follow. I said it before, if you can identify 6 wonderful businesses in your lifetime, that's all the diversification you need. 6, not 60. 6 truly great companies that you understand, that have durable competitive advantages, that are run by honest and competent people. Buy them, hold them, get rich slowly. And if you don't deeply understand individual businesses, If you don't want to read annual reports and follow earnings calls and study competitive dynamics, then just own an index fund. Seriously, that's not a failure. That's self-awareness. That's actually smart. Most people would be way better off in an index fund than pretending they're stock pickers. There's no shame in it. The shame is in owning 50 stocks you don't understand, underperforming the market, paying unnecessary fees and taxes, and wasting your time. That's shameful. What to do? If you own more than 20 individual stocks right now, you're over-diversified. Cut it down. Keep only the ones you truly understand and believe in. If you can't explain in one sentence why you own it and how it makes money, sell it today. And if that means you end up with just 5 stocks or an index fund, good. You've just improved your portfolio and saved yourself years of mediocre returns. Mistake number 5. You're bleeding money on fees and taxes, and you don't even notice. This one's boring. I know nobody wants to talk about expense ratios, tax efficiency, or fee structures. But it's costing you tens of thousands of dollars, maybe hundreds of thousands, maybe millions over a lifetime. Let me show you the math. Pay attention, this is important. Let's say you're investing $10,000 per year for 30 years. Scenario 1. You use a low-cost index fund, 0.04% expense ratio, basically free. You buy and hold. Don't touch it. Don't trade. At 10% annual returns, you end up with about $1.8 million. Nice. That's a good retirement. Scenario 2. You use an actively managed mutual fund, 1% annual fee. Doesn't sound like much, right? Just 1%. Same 10% returns before fees. But after fees you actually get 9% per year. You end up with about $1.5 million. The difference? $300,000, gone. Vanished into your fund manager's pocket for the privilege of underperforming the index. That's not a typo. A 1% fee cost you $300,000 over 30 years. For nothing. Actually, worse than nothing, because most actively managed funds don't even beat the index. So you're paying more to get less. Brilliant. And that's just expense ratios. That's just the annual fee. Now add trading commissions if you're constantly buying and selling. Bid-ask spreads. Capital gains taxes every time you sell something for a profit. Short-term capital gains, if you held less than a year, can be taxed at 37%, your top marginal rate. Long-term capital gains are 15 to 20%. Still significant. Most active traders are giving away 30 to 40% of their gains to fees and taxes. Then they wonder why they're not building wealth. At Berkshire, Warren and I obsessed over this for decades. We held stocks for 30, 40, 50 years to avoid paying capital gains taxes. Why sell? You pay taxes, you lose 20% right off the top. Now you have to find another investment that's 20% better just to break even. Stupid. Berkshire Hathaway doesn't even pay dividends. What? Because dividends are taxed immediately. The government takes its cut before you can reinvest it. We'd rather keep the cash inside the company, reinvest it in more businesses, and let it compound tax-free for decades. That's how you build generational wealth, not by paying taxes every year on dividends and capital gains. But what do? You trade constantly. You sell winners too early because you're scared of losing your gains. You hold losers too long because you're too stubborn to admit you were wrong. Every trade equals fees. Every short-term sale equals higher taxes. You're working against yourself. You're bleeding money and you don't even realize it. What to do? Calculate how much you paid in fees and taxes last year. Actually do this exercise. Go to your brokerage account. Look at your 1099 tax form. Add up your capital gains taxes. Add up your trading commissions. Add up your expense ratios if you're in mutual funds or ETFs. Add it all up. If that number is more than 1% of your portfolio value, You're trading too much. You're paying too much. Cut it out. Switch to low-cost index funds. Stop trading. Hold for the long term. This might be the single most important piece of advice I can give you. Minimize fees and taxes. It's not sexy. It's not exciting. But it might be worth an extra $500,000 to you over your lifetime. Mistake number 6. You let your emotions make your decisions. This is the big one. This is what destroys most people. This is why smart people with good intentions end up broke. Your biggest enemy isn't the stock market. It's not the economy. It's not China, inflation, interest rates, or Jerome Powell. 2. Your emotions, your fear, your greed, your panic, your FOMO. When the market crashes, you panic and sell everything. When the market's booming, you FOMO and buy at the top. You do the exact opposite of what you should do. Buy low, sell high. Great advice. Everyone knows it. Nobody does it. What do people actually do? Buy high when everyone's excited and it feels safe. Sell low when everyone's panicking and it feels like the world is ending. Every single time. Like clockwork. Let me give you some real examples. March 2020, COVID hits. Nobody knows what's happening. Market crashes. S&P 500 drops 34% in 1 month. Fastest crash in history. Panic everywhere. News channels showing death counts 24/7. Everyone's terrified. What did most people do? Sold everything. It's going to zero. This is the end. The next Great Depression. Cash is king. What did we do at Berkshire? Nothing. We sat there. Actually, we bought more. The market was on sale. Great businesses trading at huge discounts. Why would we sell? And what happened? Market fully recovered by August. Hit all-time highs by the end of the year. Everyone who panicked and sold at the bottom? They locked in their losses permanently. Then they were too scared to buy back in. They missed the entire recovery. The greatest buying opportunity in a decade, and they did the opposite of what they should have done. 2021, markets booming. Everything's going up. Crypto's going insane. Bitcoin hit $60,000. Dogecoin. NFTs. Meme stocks. GameStop. MC. Everyone's making money. Or so it seems. This time is different. New paradigm. Fed money printer. Go BRR. What did most people do? Jumped in with both feet. I'm missing out. Everyone's getting rich but me. I need to get in now. FOMO is a hell of a drug. What did we do at Berkshire? Nothing. Actually, we were sitting on $150 billion in cash, just sitting there doing nothing. People called us idiots. Buffett and Munger are too old. They don't get it. They don't understand crypto. They don't understand memes. Boomers. This time is different. And what happened? 2022, market crashes. Crypto crashes. Bitcoin drops 70%. All those meme stocks gave back everything. NFTs became worthless JPGs. All those diamond hands turned to paper. All those people who bought at the top in 2021, most of them are still underwater, still hoping to break even. Meanwhile, we had $150 billion in cash ready to deploy when everything got cheap again. Here's the pattern you need to understand. When you feel like you should sell, when your gut is screaming at you to get out, when you're checking your portfolio every hour and can't sleep at night, that's usually when you should hold or buy. When you feel like you need to buy, when everyone around you is making money and you're missing out, when it feels like easy money and you'd be an idiot not to get in, that's usually when you should wait or sell. Your emotions are designed for short-term survival. Run from the lion. Fight the enemy. Don't eat the poisonous berries. Great for keeping you alive in the jungle. Terrible for building long-term wealth. Your short-term panic instincts will destroy your long-term financial future. What to do? Write down your investment rules right now. Not during the next crash. Not during the next bubble. Right now, when you're calm and rational and not emotional. Write them down. I will not sell during a market crash unless I actually need the money for living expenses. I will not chase hot stocks just because they're going up. I will not check my portfolio more than once a month. I will not make investment decisions based on fear or greed. Whatever your rules are, write them down. Print them out. Put them somewhere you'll see them. And when the next crash comes, and it will come, and your emotions are screaming at you to do something stupid, read your rules. Follow them, not your feelings. Your feelings are trying to kill your financial future. Mistake number 7. You quit too early, you give up right before it works. This is the killer. This is the one that destroys more wealth than all the others combined. Most people try investing for 2, 3, maybe 5 years. They don't get rich. They get frustrated. They get bored. They quit. They say, investing doesn't work. The game is rigged. Only the rich get richer. The little guy can't win. And they go back to buying lottery tickets and complaining about the system. Here's what they don't understand. Wealth compounds slowly at first. Very slowly. Painfully slowly. For the first 10 years, it feels like nothing's happening. You're putting in money every month. The numbers go up a little, then down, then up a little more. It's boring. It's frustrating. You look at your account after 5 years and think, that's it? After 5 years of discipline and saving and investing, that's all I have? This is it. I get it. I understand the frustration. But here's what happens if you keep going. You're 15, you're 20, you're 25, you're 30. Suddenly, the numbers start moving fast, really fast, because you're not just earning returns on your contributions anymore. You're earning returns on your returns. You're earning returns on the returns of your returns. That's compound interest. And it's exponential, not linear. The first $100,000 takes forever. Feels impossible. You're grinding, saving, investing, and it takes years to hit that milestone. But the second $100,000 happens way faster. The third? Even faster. By the time you get to your fifth or sixth $100,000, they're coming every year or two. That's the magic of compounding. But you only get there if you don't quit. I didn't make serious money until I was in my 50s. Didn't make my first billion until my 70s. That's 30, 40, 50 years of doing the same boring things over and over. Buying good businesses, holding them, reinvesting dividends, letting it compound, not selling during crashes, not chasing bubbles, just being patient and disciplined for decades. Most people don't have that kind of patience. They want results now, and when they don't get them, they quit. They try stocks for a few years. It doesn't work, so they switch to real estate. That doesn't make them rich fast enough, so they try crypto. That blows up. They try options trading. That loses money. They try day trading. That loses more money. They spend their entire lives jumping from strategy to strategy, never sticking with anything long enough for it to actually work. Here's the truth nobody wants to hear. The stock market has returned about 10% per year for the last 100 years. Through world wars, the Great Depression, recessions, crashes, bubbles, panics, 10% per year on average. That means if you invest consistently and don't do anything stupid for 30 years, you will build significant wealth. Not maybe. Not probably. You will. It's math. It's inevitable. But you'll be tempted to quit. Oh, you'll be so tempted. In year 3, when there's a crash and you're down 30%, and everyone's saying it's the end of the world. In year 7, when your buddy made 500% on some cryptocurrency and you're only up 80%, and you feel like an idiot. In year 12, when it feels like you're running on a treadmill going nowhere, and you're wondering if this is even worth it. That's when most people quit, right before the exponential growth phase kicks in. Right before all those years of patience start paying off big time. Don't be that person. Don't quit. You've already done the hard part. You've already suffered through the slow years, the boring years, the years where it feels like nothing's happening. If you quit now, all that was for nothing. But if you keep going, if you give it another 10, 20 years, you'll be in the top 5% of wealth in this country. Guaranteed. So here's my last piece of advice and then I'm done. Pick a strategy, index funds, dividend stocks, value investing, whatever. Something boring and proven, something that's worked for decades. Then stick with it for 30 years minimum. Not 3 years. Not 5 years. 30 years. Don't quit when it's hard. Don't quit when it's boring. Don't quit when your friends are making more money doing something else. Don't switch strategies every 2 years chasing the next hot thing. Just keep going. Keep contributing. Keep reinvesting, through crashes, through booms, through boredom, through FOMO, through fear. Just keep going. That's it. That's the whole game. Avoid these 7 mistakes. Be patient. Be disciplined. Don't quit. You won't get rich in 5 years. Probably not in 10 either. But in 30 years, you'll be wealthier than 95% of people in this country. And you'll have done it without stress, without gambling, without getting lucky, just by being patient and not being stupid. Now, if you made it this far, you're serious about this. Most people already clicked away looking for top 5 stocks to 100x in 2024, or whatever garbage is trending. Good. Less competition for you. More opportunities for patient people who actually understand how this works. Hit that subscribe button if you want more of this. No hype. No hot takes. No predictions that'll be wrong in 6 months. Just timeless principles that worked 50 years ago and will still work 50 years from now. That's what this channel is about. Final thoughts. The Warren Method in 1 sentence. The entire philosophy of the Warren Method can be summed up in 1 sentence. Avoid stupidity, embrace boredom, and let time and compound interest do the heavy lifting. That's it. That's the secret. There's no magic formula. There's no get-rich-quick scheme. There's no shortcut. There's just avoiding mistakes, staying disciplined, and letting time work for you. Your action plan. If you're serious about building real wealth, here's what you do right now. Stop trading. Sell everything you don't understand. Keep only the investments you can explain in 1 sentence. Read 1 investing disaster case study this month. Learn from others' mistakes. Write down your investment rules. Follow them no matter what. Calculate your fees and taxes from last year. If they're more than 1% of your portfolio, you're paying too much. Pick a boring, proven strategy. Index funds, dividend stocks, value investing, whatever. Then stick with it for 30 years. Ignore the noise. Turn off the financial news. Stop checking your portfolio every day. Never quit. Keep investing, keep compounding, and let time do its magic. The promise. If you follow these principles, if you avoid these 7 mistakes, you will build wealth. Not overnight. Not in 5 years. But in 20, 30 years, you'll look back and realize you've done something extraordinary. You'll have financial freedom. You'll have security. You'll have options. And you'll have done it the right way, without stress, without gambling, without getting lucky. Final warning. Most people won't do this. They'll keep chasing the next hot stock, the next crypto boom, the next get-rich-quick scheme. They'll keep making the same mistakes over and over. And they'll keep wondering why they're not getting ahead. But you're different. You're here. You're listening. You're ready to do what works. So go do it. Go be boring. Go be patient. Go be disciplined. And in a few decades you'll be very, very rich.